Well, let's focus on the oil and gas space then. We're now joined by Dayanand Mittal, the oil and gas telecom research analyst at JM Financial Institutional Securities, who joins us on the show. Hi, Dayanand. Good morning. Thanks a lot for joining in. Well, the next big event for Gail is going to be the tariff increases, right? How much upside would tariffs bring for Gail, if you've done some math on that? And also, Gail's, Gail Gas listing, how much it adds to the valuations? If you could give us some brief numbers.
Good morning, Ajil.
Good morning.
In terms of tariff hike, is long pending since the APM gas got deallocated for the gas transmission business, and the cost of their operating cost of gas with the use in transmission business has gone up significantly from $3 to now $10. So given for GSPL regulator had made those changes, so for GAIL it's just a matter of time when those final numbers gets revised. So our expectation is versus 57-58 rupees per unit that they get currently, we are building in conservatively 65-66, while companies applied to PNGRB for 77 odd, and companies saying at least they're confident based on their understanding that 71-72 is what they should get. So assuming they get closer to 71-72 versus broadly we and Street are building about 65 odd, so there could be about 10% odd upside to earning and similar kind of an upside to valuation. So that's on the transmission part. So I guess it's a matter of time before it comes. Don't think there's much debate on the rationale for the hike. On Gail Gas, yes, listing is pending, but last 2-3 years, the outlook for CGD sector has got a bit deteriorated, particularly after the Russia-Ukraine crisis, leading to spike in global gas prices. And hence the input cost for all the CGD companies, given APM deallocation, surge in APM pricing, high spot LNG prices. So the outlook for CGD company has deteriorated over the last 2-3 years. So we are not very optimistic about too high a valuation for Gail Gas, but yeah, whenever it happens, so we don't build much upside per se from Gail Gas listing as of now, but whenever it happens, that could probably some 2-3% kind of a bump up to valuations as well.
Okay, got it. All right, not too much on that front. All right. Could you tell us, about, since we're looking at oil and gas space, and now you have crude oil prices, that earlier this year went down to around $55 a barrel. They popped back up and holding around this $66, $68 per barrel mark. What's the view on ONGC as well as Oil India? Do you think valuations and steady crude prices with the hike in production are enough to be interested in the stock?
So we have a positive view on Oil India. Also, we like ONGC, but we prefer Oil India. First, just some quick view on crude price. So our sense is the two key global players who are driving this prices, one is Saudi, second US. So the near-term interest seems to be aligned to keep crude price a bit soft, particularly US. US President wants Fed to cut rate. We saw one cut yesterday, but it's small in what US President wants. And they also want Russia to come down to the negotiating table. So for both these to happen, then US President needs oil price to remain soft in the near term. And given Saudi's strong relationship with the current US President, Saudi is obliging to it. And so this last week, OPEC plus output hike, where this now reversing the second set of voluntary cut of 1.65, that came as a surprise to us. And in our view, that will ensure crude remains soft for next 3-4 months, because this monthly hike might continue till US President gets both his objectives. But from a one year plus view, we think Brent prices are likely to stabilize more around $70-72, primarily because the break-even price for shale is around 65-66, plus Saudi needs high oil price to match its fiscal deficit. They need about 80-85, and also they need to keep selling stake in Aramco to fund this diversification strategy. Also, US President wants shale investment to continue, given for the US energy exports will be a key source of reducing trade deficits. So medium-term view is oil will be around $70 so. Near-term, it may remain soft. So next 3-4 months perspective, maybe ONGC Oil India remains soft. But yeah, I think valuations are quite reasonable. They're discounting $60 kind of net crude realization. So downside is quite limited. So one can buy with a 1 year view, I think, in both the names. We particularly like Oil India because it could be a 2-3 year compounding story.
Dayanand, finally, I was going through some notes which were trying to get to the overall currency impact, because the rupee is down 3% over the quarter. So whether you're talking about city gas distribution companies, even oil marketing and refining companies, at the end of the day they're all importing, directly or indirectly, whether it's oil or gas. Are you baking that into your estimates? I mean, overall, as we gear up for this earnings season, what should we watch out for?
So from oil marketing companies, things are quite robust. Last year was a very, very strong quarter, 1Q. 2Q would also be quite healthy, though maybe down QOQ. This currency moderation will provide some relief. The sharp depreciation of currency was becoming a concern, so some relief there. But what's more positive from OMC's perspective is crude likely remaining soft and hence marketing margin remaining strong. So OMC's 2Q should be quite decent above normal earnings. For CGD companies, yes, this given they don't have much ability to take price hikes, given very limited differential between CNG and petrol diesel now. So this INR appreciation should ease concerns which was arising over last few months when INR was depreciating sharply. So CGD should be a steady type quarter, nothing major in the results. OMC should be a strong quarter in 2Q.
And what's your top OMC pick in that case?
So we are more neutralish in OMCs, so we prefer more BPCL, and primarily because of its strong refining play, and refining we think margins should remain strong in the near term, and also IOCL, but that's more on the valuation grounds. So IOCL is trading at 0.9 time price to book versus 1.2 to 1.3 for BP and HP.
Absolutely. Then on just one last question, we've done the micros, etc. Prashant, morning. Just one macro question, but I think it's also very important. Do you know what is the difference between Russian oil and say the Indian basket? Is there because the difference has been coming down dramatically?
Yeah.
And that is, at some point if the difference is immaterial, we may actually stop buying because it doesn't make sense, and then the problem is resolved on the tariffs, etc. Do you know that number?
Yeah, so broadly, even OMC's management, we keep interacting. So they broadly suggest the discount is around $2 to $3 per barrel currently. It used to be $3, $3 to $3.5, let's say 6 months back. Obviously, post this Russia-Ukraine crisis was very high at $9 to $10. This number that I'm telling is net of higher transportation and insurance costs, so net benefit to OMCs, let's say. So given we import about 30-odd%, so OMCs import about 30-odd% of their crude from Russia, so that adds about $1 to the GRM. $1 to GRM for OMCs is quite sizable, about 8 to 10% EBITDA is what $1 implies in terms of overall consolidated earnings. So it's quite sizable still. And given US and Europe is trying to further tighten sanctions on Russia, that would mean the discount might continue. So I don't think the discount is ending anytime soon, unless as part of this Russia-Ukraine settlement, maybe the sanctions gets removed, which is obviously it's very fluid, difficult to take a call.
All right, no, absolutely. But as you said, I mean, from $9, $10, it's come off quite sharply, right? So maybe you're at a point where you need to assess at $2, $3, and if it comes a little bit more, maybe the trade-off in that sense. But interesting times. Thank you very much for joining us, Dayanand. It's always a pleasure, and look forward to having you back on the program here on CNBC TV18.